there's going to be tremendous pressure on the Fed to create inflation, not to fight inflation. And so when the markets realized that the Fed is not going to be victorious in this fight against inflation, it's going to surrender, inflation is going to win, gold is going to go ballistic.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
What was your take, first of all, on Chair Powell and maybe their strategy going into the summer?
Well, I kind of think the Fed is done, at least for the time being. I don't believe that they're going to follow through with the additional rate hikes that they're forecasting between now and the end of the year. I think they paused for a reason. I think if they really were committed to continuing the inflation fight, they wouldn't have paused. They would just raise rates because they've admitted that they're still not high enough and inflation is a bigger problem than they thought. So why pause? I think the reason is because they're also paying attention to the damage that higher rates are doing to the real economy, and in particular to the banks and the financial system. And so I think they don't want to put any added pressure on such a fragile situation. So they stopped hiking. Yeah. But I don't think it's going to matter. I think that just leaving rates where they are is too big a burden for the system to handle. And you have to keep in mind that rates are not high. 5% historically is low. I mean, if you go back to the era where we've been on fiat money, go back to 1971, sure. And where have the Fed funds rates been? 5 is not high. It's only high in relation to where we've been for the last 14 years or so, in this unprecedented period of monetary excess. But we now have the highest inflation since the 1970s, yet interest rates are nowhere near where they were back then. So they've got a long way to go up, but of course the Fed can't let them go up, which means inflation is what's going to go way up. That's why I'm so bullish on gold, because I'm very bearish on the dollar.
All right, so a couple of things playing out on this, because you mentioned obviously the strategy that Powell has taken, both on the approach of not necessarily looking at additional rate raises. You look back at his acceleration, because it's really all about speed in which they got to 5%. It pretty much wrecked the bond market. Obviously, we saw flights of capital go into money markets. I mean, does that not look like pretty much a rug pull on the banking system at the speed in which they did this?
Yeah, I mean, certainly the bankers didn't anticipate that the Fed would be this aggressive. In fact, early on, I didn't think they'd do it either. I didn't even think they can get away with it. I thought that pulling the rug out from under the economy, would topple it faster. So I was kind of surprised that they were able to get rates to 5% without more damage. Now, of course, we got that damage and they backstopped it. We had Silicon Valley Bank, Signature Bank, these massive failures. And there would have been way more had the government not come to the rescue. It already would have been a much bigger financial crisis than 2008. Now, all they've done really is been able to hold it off. But the momentum is building as rates stay where they are, and more, low yielding debt matures in a higher rate environment. But the pressure continues to mount on the banks because the value of their collateral is collapsing. Not only the treasuries and mortgage-backed, but their commercial loan books are imploding. Yeah. And they're losing their deposits, because their customers are taking their money back because they could buy a money market fund and get 5%. They're still paying 0 on checking. You get maybe 0.25% at most on savings accounts. Yeah, you can get a couple of percent if you buy a CD, but why lock your money up for 3 or 5 years when you can get more just putting it in a money market and getting a checkbook? You can get money market checking at a brokerage firm. I think the pause is going to be here for a while. I think they paused for a reason. They don't really want to hike, but they don't want to say that. So they have to pretend they're ready to hike more, but don't actually hike more.
Right.
Now, maybe they're hoping that the inflation numbers really come down so that they have a justification for not hiking more, or maybe the economic numbers weaken, which that's more likely. It's more likely that we see weaker economic numbers, maybe a pickup in unemployment, or a decline in the non-farm payroll reports. The economic data that's coming out, look at all the data that came out today. The unemployment claims very weak, much greater than expected. Philly Fed was worse than expected. The industrial production capacity utilization worse than expected, all negative.
Right.
I mean, we're getting negative number after negative number. So, I mean, this is stagflation. I mean, there's no question.
Yes.
The economy is weak. The only thing that, Powell is pointing to that he claims is strong is the labor market. And I think there, he's missing some clear signs that there's a lot of weakness in the labor market that he doesn't just recognize.
Do you feel like central banks will continue to pile into the gold bandwagon here?
Yeah, in fact, they're not even piling in yet, they're buying. But I think they're going to be picking up the pace once the price of gold really starts to go up. I mean, maybe right now they feel they can go slower, and they're taking advantage of the fact that the price has been relatively stable. It is a bit surprising that it hasn't already moved up given what's going on. I think that's causing some people to kind of doubt that it's ever going to move up, because they'll say, well, if it can't move up given the circumstances, it'll never move up. Well, that's just not true. It's just taking time. Remember, I think the big headwind that gold has faced, one was the strong dollar, and the dollar is surrendering that strength now. It hasn't broken down yet. I believe it soon will. It's having a very weak day today. But also, the markets still believe the Fed. They still believe Powell when he says he's committed to doing whatever it takes to bring inflation down to 2%, no matter how high rates have to go, no matter how long they have to stay there. And that has been a headwind for gold. But what's optimistic is that even with the expectation of this higher for longer, gold has not gone down. It hasn't gone up. It hasn't sold off either. It's kind of holding its own. But I think eventually the markets are going to realize that this is all bluff, that Powell really doesn't have the cojones to fight inflation when that fight causes severe collateral damage to the economy, to the banking system. I mean, in his Q&A yesterday, he said that he's never going to tell Congress to stop spending or stop the deficits. He said that's none of his business. Fiscal policy isn't any of his concern. Well, that means he's going to have to monetize all those deficits that he refuses to criticize, which are skyrocketing. There's going to be tremendous pressure on the Fed to create inflation, not to fight inflation. And so when the markets realize that the Fed is not going to be victorious in this fight against inflation, it's going to surrender, inflation is going to win, gold is going to go ballistic, so I just, feel that, I'm willing to wait it out, because I know how much it's going to go up when it finally moves. And I'd rather own it now and wait than have to scramble to buy it later at a much higher price.
I mean, do you feel like that you're saying that this could accelerate faster and we could see the 2021 type dip again when you look at this, or even further cuts in terms of the dollar?
Well, no, I think it's going to fall precipitously. I mean, you really have a perfect storm right now of destruction for the dollar, because the Fed tightening cycle is coming to an end. And so that's been the tailwind for the dollar. It's now going to be a headwind. I mean, it's going to be weakening the dollar. But you also have this unprecedented movement now around the world to de-dollarize. Countries that were significant buyers of dollars and then U.S. Treasuries are now sellers. China obviously doesn't want our dollars. It doesn't want to buy new dollars. It wants to get rid of dollars it owns. Same thing, clearly Russia, is not a dollar buyer anymore. Saudi Arabia doesn't appear to want dollars anymore. Brazil, India, you got major exporting countries that have huge dollar surpluses in their trade, and large dollar reserves in their holdings, that want to unload. And so this is going to put tremendous pressure on the dollar at a time where our budget deficits and our trade deficits are in record territory. We've got $1 trillion a year trade deficits, $2 trillion a year budget deficits. There's no place for those $3 trillion to go. So this is massive inflation because, for years and years, America exported its inflation. We printed money and sent it out to places like China. They used the money to buy treasuries, which kept our rates low. And then they shipped us goods that they produced, which kept consumer prices low. Right. Now we're going to import that inflation back because now the Chinese aren't going to want to buy these dollars. And so therefore Chinese goods are going to be more expensive. We're not going to buy as much stuff. So our prices are going to go up. And now the Chinese are going to take those dollars that they used to hold in treasuries and they're going to come shopping in America to buy our stuff. And a lot of it isn't going to be the new stuff that we make, but it's going to be the old stuff that we already own.